Welcome everyone to our fourth quarter 2020 and full year results presentation. 2020 was an extraordinary year. With the COVID pandemic, the economic downturn, dislocations in commodity prices, with at one point for the first time in history, a negative oil price, 2020 was a very challenging year across society. For Shell, while it was tough, it was also a year of delivery. Delivery of the decisive measures we took to preserve cash and delivery of solid and resilient operational, safety, and financial performance while we focused on care for our people, customers, and communities. Let us look at our performance in 2020 in more detail. Despite the weak macroeconomic conditions and various challenges impacting our staff and operations throughout the year, our adjusted earnings amounted to almost $5 billion, and cash flow from operations was $34 billion in 2020. Our industry-leading cash flow delivery was achieved through the resiliency of each of our businesses, with strong full-year cash generation in integrated gas, upstream, oil products, and chemicals. We reported $21 billion post-tax impairments across our portfolio in 2020, given the challenging outlook for commodity prices and margin assumptions. We delivered our cost reduction targets for the year. In fact, we exceeded those targets. Our organic free cash flow was $18 billion, close to 2019 levels. We reduced net debt by almost $4 billion, and we delivered this performance safely. We had no work-related fatalities in Shell-operated ventures in 2020, and we reported fewer injuries than in 2019. So, at the start of the COVID crisis, to protect our balance sheet and ensure financial resiliency, we took the difficult but prudent decision of rebasing our dividends. This has allowed us to reduce net debt during the year and retain a strong base to respond to changing dynamics, as well as drive our strategy. In Q3, we said that we plan to raise the dividend per share annually, in line with our progressive dividend policy and subject to board approval. We increased our dividends per share by some 4% in Q3 2020, and we expect to grow it by a further 4% as of the first quarter 2021. Our operational and financial performance in 2020 shows that, from our portfolio decisions to cash preservation measures, we have made Shell more resilient to deliver strong cash throughout the cycle. We proved our ability to adapt, and we see that our integrated business model has served and will serve us well. The portfolio decisions we made in 2020 further strengthened our businesses across our three pillars: growth, transition, and upstream. Let me start with our growth pillar: marketing, power, hydrogen, biofuels, carbon capture and storage, as well as nature-based solutions. We focused on establishing new business models in power and hydrogen. For example, in the Netherlands, our Crosswind joint venture won the tender to develop the offshore wind farm Hollandse Kust Noord. We will supply electricity to our customers and aim to power a 200-megawatt electrolyzer in Rotterdam. This takes us a step closer to building integrated renewable energy systems to meet our customers' evolving needs for power. And our marketing business had one of its best years in 2020, despite the unprecedented drop in demand. I will come back to marketing in more detail soon. Our transition pillar, which consists of integrated gas, chemicals, and refining, made a number of key strategic and portfolio shifts in the year. Take refining, for example. In total, we made significant moves with 6 of our refineries in the year, either exiting, divesting, or repurposing them to align our assets with the future of energy. We are also working on opportunities to address carbon emissions that are difficult to avoid. A good example of this is the progress made to put in place further carbon capture and storage at our Pernis refinery in the Netherlands. In integrated gas, we were also disciplined in executing our strategy. We exited projects that were not competitive within our portfolio, like the brownfield LNG project Lake Charles in the US. And we also brought the first carbon-neutral LNG cargoes to market, taking advantage of our capability to offset carbon emissions with nature-based carbon credits. Finally, our upstream pillar. We are simplifying and strengthening our upstream portfolio. In 2020, we divested more non-core assets while focusing on our 9 advantage core positions, which generate more than 80% of our cash flows, and Brazil Deepwater is one of them. For example, we took final investment decision on Mero 3 in the Santos Basin, strengthening our position in our resilient and cash-generative deep water assets. Across all our business pillars, you can see our strategy defining the portfolio decisions we made in 2020. Let us now look at our marketing business in more detail. Shell has built a leading position in marketing. We serve around 30 million customers every day in about 80 countries. From fuels to our digital solutions, we bring value, quality, and convenience to our customers' lives. Being connected to so many customers every day gives us unique insights into their preferences. This closeness, combined with our scale, are key competitive advantages in this growing business. Early in 2020, we quickly adapted to the new reality. We kept our sites open, running, and safe. And we selectively expanded our operations in key areas of growth, mainly in Asia. Also, we increased our convenience retail offerings and digital services. Our basket size from our convenience stores increased by 15%, which more than offset the decline in demand. We significantly improved our OPEX yield to more than 60% and increased the margin share of our premium fuels and lubricants to record numbers. So marketing reported strong financial performance in 2020 in a challenging environment. This performance in such a difficult reality reinforces our belief in the growth potential of this business. From upstream and our transition businesses to our growth businesses, our portfolio showed great resilience last year. And while we focused on our customers and operations, we also remained disciplined on cost. When we saw the first clear signs of the macroeconomic challenges ahead, we acted fast and decisively to preserve cash. We announced cost reduction targets early in 2020, and we delivered on them. In fact, we exceeded them. Let me start with operating expenses. We said we would reduce our underlying OPEX by $3 to $4 billion compared with 2019 levels by Q1 2021. By Q4 2020, we delivered $4.5 billion in reductions, exceeding the total target and ahead of schedule. We achieved this by reducing activities and through structural improvements. From implementing remote inspections to improved digital financial tools that will serve us going forward. We accelerated digitalization across Shell and expanded activities in our business operations centers in Krakow, Bangalore, Chennai, and Manila. In short, we made Shell simpler and more cost-effective, and we see further opportunity. We are completing the redesign of our organization that will come into effect in the second half of 2021. Beyond lowering our operating expenses, we also said we would cut our cash capital expenditure by $5 billion compared with our original plan of $25 billion for 2020. In fact, we reduced it by more than $7 billion, with rigorous capital discipline, with capital efficiency, and by stopping or rephasing projects. We also optimized our working capital by revising payment terms and inventory levels. Let me now turn to the fourth quarter. In the fourth quarter, oil and gas prices and energy demand recovered slightly compared to earlier in the year, but were still far lower than in Q4 2019. Refining margins, while up from Q3, remained at historic lows. And chemicals started to see some recovery in margins. We saw relatively low volatility in the quarter, leaving fewer opportunities to generate additional value from trading and optimization in oil products. Our volumes were hit by lower demand, OPEC Plus restrictions, and hurricanes in the Gulf of Mexico. But despite these headwinds, our financial performance in the fourth quarter was good. Our adjusted earnings amounted to nearly $400 million, and we delivered $6.6 billion of cash flow from operations excluding working capital movements. Our net debt increased by nearly $2 billion to $75.4 billion, mainly due to lower free cash flow generation, including a small outflow in working capital. Reducing net debt to $65 billion remains our priority. Once we achieve this milestone, we aim to distribute, in aggregate, 20% to 30% of our cash flow from operations to our shareholders. Let us now go through some of the key factors behind our financial performance in the quarter. Compared with the same quarter in 2019, our earnings reflected significantly adverse macroeconomic conditions. This impacted our realized prices, margins, and volumes, and hit our adjusted earnings by over $4 billion, as you can see in the chart. We offset some of this impact by reducing our operating expenses by more than $1 billion compared with the same quarter last year. and our cash conversion was again strong in the fourth quarter, which demonstrates our capacity to deliver robust cash flows, even at what might be the bottom of the cycle. Our cash flow in the fourth quarter was impacted by an outflow from commodity derivatives of almost $900 million, while last year saw an inflow. Overall, the difference year on year is an impact of some $1.7 billion. As stated before, these derivative movements are driven by the change in commodity prices and are eventually offsetting over time. We're also pleased to see higher cash generation from our chemicals business, showing the strength of our integrated business model. Chemicals has realized better base and intermediates margins across most product lines, mainly because of improved demand in Asia. And with that, let me summarize the highlights. We delivered robust operational performance and financial results during an extraordinary year. These results reflect the swift and decisive actions we took to preserve cash. Our performance also reflects our resilient portfolio, our integrated business model, our steadfast people, and our deep capabilities to manage adversity and market dislocations. Together, these create our capacity to deliver robust cash flow through the cycle, today and into the future. So we entered 2021 proud of our delivery, eager to contribute to the recovery, and energized to accelerate our strategy to make the future of energy. I look forward to engaging further on the future of energy with members of our management team at our Strategy Day on the 11th of February. Thank you, and please stay safe.